Splendid evening it is to you, Zimbabwe. Welcome to Equity Access. This is Eben Mabunda signing in as your host. This afternoon, ZIMSTAT published an annual inflation rate figure for the month of October as having been 20.85%, which was up 386.6% from a 5.39% figure recorded for the month of September. Now, this is compounded with the fact that in the economy at the moment, shelves are running almost empty of certain basic commodities. In addition to that, the local currency is losing value on a day-by-day basis. Remember that in 2008, we had hyperinflation in Zimbabwe. I know there's a figure on record of 79.6 billion %, the highest ever recorded in human history. Your thoughts on that, gentlemen?
It's quite an interesting situation, just comparing it to the current period, which is 2008. I'm just going to skip the whole 2013, 2014, what happened. I'm sure Anis is going to elaborate on that. But I just picked something that's very interesting. That in 2008, we did see shops actually running empty on a lot of on just everything. And then you see that trend is starting to repeat itself. Correct. In 2018, now 10 years down the line, where you see some basic commodities are not available and things like that. So we'll just touch on something that has something to do with the fiscus as well, just with regards to this point.
Okay.
There's something that's very interesting actually in terms of relationships of what's happening now in 2018 to what was happening in 2008 in terms of monetary supply and things like that. We're just going to touch on that at a later stage, but I just thought I should just highlight this point.
Okay. Just to, as I said, just to go back in history, in 2009, following the hyperinflationary conditions, we see the introduction of a multi-currency system, dollarization, right? At that point, we see stability in the economy. The inflation is stable. There are two factors basically at play. On the one hand, we see that the US dollar, which is the prime currency in the multi-currency system, is not subject to manipulation down here. Then on the other hand, we also see a scenario where there is a bit of an equilibrium between the level of demand in the economy, the production side vis-a-vis the money supply that we've got in the country. So the inflation is stable at that point. In 2016, we are basically emerging from a period of deflation, as indicated by the red line, which is the headline inflation. When we get to February 2017, we see inflation resurfacing, and there's a stated growth in the level of inflation right up until August of 2018, at which point we see the inflation rising up. In 2018, October, September, we see a spike in the level of inflation, right up to 20.85%. Gentlemen, your thoughts. I'll start with you, Anisu.
All right, thank you, sir. Basically, I would like just to take us a little bit backwards, because history could be the best prophet of what's happening today.
Bring it on.
So, as we see, we are coming from a deflationary period, whereby around about 2009, dollarization had been introduced, and things had seemed to go steady, where things were now pretty much in equilibrium with money supply and demand. So in that situation, we also then achieved a point where we were coming down into the negatives of inflation. This came about because of one point that you highlighted earlier on, where regional currencies were weakening against the US dollar, basically because basic commodities around the world were dropping in price. And these regional countries normally depend on these commodities. So as we went on further into the years of the 10 years that we've gone by currently, we are seeing that money supply was now being reintroduced through things like treasury bills that came in 2014, and we had bond coins that were coming in 2016. So we then begin to see that the fundamentals are beginning to be shaken by such introductions, where the treasury bills were coming down from about 200 million in December 2013 up to 9.8 billion, which is pretty much shocking. for any economy.
Okay.
So that simply just shows us that money supply has an effect on what we are facing today, which is the 20.85% inflation. That money supply now, through treasury bills, has come to a place where it has crowded out private investors, private firms from being able to trade on the local market. So with that having been done, the supply side now was affected, and that then started pushing up their costs, which then translates into the rise of prices.
Can you tell us what's the relationship between the money supply in question and the inflation that we are seeing reflected in the economy?
I'm just going to mention the issue of bad money actually being the one that drives away a good money from our economy. Actually, why I did mention that point is the fact that like what Anis had mentioned, that we dollarized, we sort of got into a multi-currency issue in 2009, right up until 2013, where the issue was quite strong in Zimbabwe. Then post 2013 came the election, then the ruling party got big power, and then our finance minister Tendai, who used to say government should actually eat what they kill. And I was going to say kill what they eat, but so he was actually saying government should actually eat what they kill. He was trying to say that government shouldn't overspend above what they actually collect from ZIMRA as actual collections. So just coming post 2013, we did realize that government actually started to actually overspend. Hence, we did see just coming from a 200 million money supply for in December of 2013 up until we grew up up until 9.8 billion in 2018. That's coming as a result of the government that's actually really spending a lot of money on a lot of things that are getting involved in the likes of Commander Greek and so forth. I'm just going to go back to my point of bad money actually driving away good money. So as a result, government was actually supplying, is currently supplying this money through the issuance of the likes of treasury bills and paying off those using RTGS balances. And we just know as Zimbabwe that there's no money actually like proper like physical money to actually match the balances that we have actually in our banks at the moment. But just our 9.8 billion, the bulk of it is just balances that are lying in the banks. And there's nothing on the ground in terms of US dollars to match the money. So I'm just going to go back to our suppliers here who are actually supplying goods into the supermarket. Most of them, as Zimbabwe, we know our manufacturing sector is really down. We've been having like 40% of our total capacity utilization in our industries. So our industries are actually lying dormant at the moment, and a lot of suppliers are importing a lot of goods to actually make their supplies to supermarkets, or importing is something like soap and toothpaste, the things that we're not supposed toothpaste the things that are not supposed to be importing. So these are some of the things that are putting pressure on our prices. There's no US dollars in the market, but then our suppliers need a lot of US dollars to actually be able to manufacture their goods. What do they do now? They just go to the black market and they be buying US dollars at very, very high rates from the boys in the streets.
Kenneth, from what you're saying, this could have an effect on the real GDP. Remember that beginning of the year, government issued a statement that they were working towards a 4.5 growth in the real GDP, and then later revised to 6.5%. Do you think we are within that?
Their rebase could have come from a place and a pivot where on October the 1st, the new finance minister came in and introduced a 2% tax that is supposedly supposed to help with the growth within the GDP. But in actual economics, that is not real growth, because that is only tax money that is supposed to help with reducing the budget deficit. Now, with that being said, that 2% tax is going to end up strangling production, as it is going to increase the cost of production and the like. So then, essentially, that 20.85% rise in inflation is going to push down production, which should actually have the government start rethinking around rebasing their growth to something which is very much close to zero or less, if I'm to be extreme.
Okay. On the very same day, we see the separation of the nostro foreign currency accounts from the real-time gross settlement deposits, the RTGS. Do you think that we could be reeling from the effects of that day, Kenneth?
This is the government that's now trying to correct itself, that's realizing that actually we've driven away the good money from our economy using these board notes and RTGS something. And also the government that's coming from a point of starvation, where they know that they're not really generating any foreign currency themselves. And they know that foreign currency is being generated by citizens. And they know the fact that their industries are are so much in need of the forex in order to boost production. So the only way was actually to assure the citizens that actually you can just open your foreign currency account with your bank, and then the rest that's going to happen is your US dollars, your pounds, your rands are going to come in, and then they'll be safe. Okay. No one is going to tell you that you can actually deposit dollars and then withdraw, get your money through RTGS, things like that. So from the government's point of view, they're trying actually to actually source, to actually crowdsource the US dollars from the people. Then they'll be using that money also to supply to supply industry. I'm just going to remind you that the government is actually quite involved through the RBZ in helping the guys that are bringing fuel, the guys like Delta that are producing a lot of soft drinks and foodstuffs. These foodstuffs that I mentioned, that just because they're vanishing from the shelves of the shops, then we're seeing this rise in inflation up until to 20.85% for this previous month. So it's just the government that's trying to source forex and just assure the citizens that once you have your forex in the country, your forex is quite safe with us. But it's just a subtle way of trying to raise more money also to fund the ailing industry.
Kenneth, the question is still unanswered. You just explained what the government was trying to achieve, but the question is, what was the reaction of the market? How did they read it? What was the interpretation of that as far as the market was concerned? Okay,
it was quite horrible, man. So we're actually seeing the government that's really big on making gaffes here.
You are back to the government.
Yes,
the market.
Yeah, I know. It's the government that's really big on gaffes. We've seen that in the previous periods where they made quite some interesting gaffes. And this one was quite a huge one because in their mind, they're thinking that they're correcting something that was bad with the forex issue. But then the market interpreted it as something that they were saying that, okay, these guys are now finally admitting that one board note is not equal to US dollar. And that did come out really negatively on the part of the black market guys. Within just spark the rates for the US dollar by more than like 200% to 300%, where we saw the bond trading around 500% with the US dollar. And just because of that, a lot of people with US dollars in their homes just went to the black market, sold them, and they just had a lot of RTGS balances, just like what the guys at OK said during the interim results announcements, that thing actually resulted in a lot of spike in terms of demand from the side of the consumers.
Okay.
And because of that, a lot of retailers are actually worried about their inventory levels. They just had to react by protecting their inventory levels and also their profitability levels, just to match the kind of the spike that happened in the market.
Okay.
And we did see a huge jump in profit, which I'm quite sure that the 20.85% we did see today from ZIMSTAT could actually be a very humble figure than what we should really have.
Okay. Prof. Hank, a country-renowned economist, just tweeted that inflation is actually above 100%. Do you think this 20.85 figure released by ZIMSTAT is an authentic figure?
There is some semblance in what Hank has said and what ZIMSTAT also mentioned. But then the only problem that I would have with Hank is that he is basically hinging his 100% plus inflation rate on the old mutual implied rate, of which that implied rate could have been simply manipulated by the 2% electronic transfer tax.
Okay.
How? When that 2% was introduced, we saw an influx of people coming into the stock market where they were trying to dump their RTGS values into something more valuable, which was stocks. This then overvalued most of the stocks on the stock exchange. But then we can't really pin it down to that because that implied rate, it fluctuates.
If you're just joining us, we're discussing the recent developments of the 20.85% inflation figure published by ZIMSTAT. And to discuss that, I have our very own investment analyst, Kenneth, as well as Anisu. Okay, gentlemen, in a recent development from the fiscal side, we have a statement issued by Professor Mthuli Ncube to the effect that there has been a reduction in government expenditure over the month of September. Do you think that that could have a correctionary effect on the inflation figures that we've just recorded?
I'm just going to say I'm in support of what Mthuli is saying. When Mthuli came in, I think his thrust was actually to really try and curb government expenditure quite a lot. When he, I could give you an example when he did face some kind of outrage from the MPs when he said he wasn't going to buy cars for them, which was quite controversial given that MPs are supposed to be working in their constituencies. But now, just coming back to the consumers and the government really spending a lot than what they're collecting. I think in terms of inflation, I just think maybe things are going to start coming back to normalcy. But maybe I'm seeing towards the end of 2019 or even 2020, people shouldn't really be excited about these things because our government is coming from a very low base, and we need to actually put in a lot of work for us to go back to the equilibrium. Actually speaking, in terms of economics, our demand is just supposed to always be equaling our supply. But then just looking at our supply side now is very dead because of these issues with something to do with money, where we have a lot of RTGS balances in our banks, including companies themselves. But then we can't really use that money outside the borders of Zimbabwe, where we need to source a lot of our inputs. So I'm just thinking if we could really correct ourselves to go back to equilibrium, which is what Mthuli is trying to do, perhaps we could see ourselves returning back to normalcy, like what happened to us during the 2009-2013 period, where the then Minister of Finance was really putting his foot down, saying that government should actually spend what they kill, full stop. I think if Mthuli actually also adopts that kind of mentality, and also be telling people about the progress, like what he did recently, that he reduced government expenditure just within a space of 1 month. Then after 12 months, we could be speaking about something that's really positive.
There was an outcry from the masses as to whether a due process had been taken. Was there buy-in by the Labour? Was there a buy-in from Parliament? It seems as though that move was just, an imposition on the masses, which then brought with it seismic shifts in the economy. And so do you think that the reviews that are forthcoming could actually see Zimbabwe take on a different trajectory?
Eben, with what you've asked me, what I sense is that, yes, President E.D. Mnangagwa has decided that there needs to be a revision of the 2% tax. But then what that entails is that the projections that Professor Mthuli had made in accordance to the incomes that are going to come in from that, which could have offset the deficit, the deficit that was there, is going to be affected. Because what he was expecting was, albeit 2.8, 3.5 billion a year on the tax. Now, if it is going to be revised, that means it is going to take us a longer time to cut down that deficit. But then questions like, will the government expenditure remain constant, go lower or go up? Is trade going to improve? What our remittance is going to come up looking like? Those are other key factors that we need to look at, because without those, we are not going to be going anywhere. So far, the red line may just become the new black.
Okay, in layman's terms, so much for the jargon. What are we saying for the man on the street? Are we likely to see prices on an upward trajectory? Is that spike the new normal for Zimbabwe, or we're likely to see things be being corrected? What's going to happen? Kenneth?
Okay, so before I answer your question, I'm just going to touch on what you said in terms of remittances. So in terms of Edim Nanga was saying that they're going to have to revise downward the 2% tax. What I'm saying here is our major worries are two things here in Zimbabwe. The first one is for the government to actually be able to reduce its expenditure, and the second one is the issue around us just getting enough forex. So in terms of the 2% revision downwards, like what Anis has mentioned here, we're just gonna see government actually not really being able to actually reduce the gap, their budget deficit. Like as Zimbabwe, we're actually seated at above 63% in terms of our budget deficit, but then as a developing country, we're expected to hit the maximum of 40%, which we are over 20% above that. So revising that tax downwards is going to make sure that that budget deficit trend is going to continue for quite some time. But now in terms of us having able to receive the forex, we're actually earning forex from companies companies that are in mining, companies and individuals that are actually farming tobacco. Those are the sectors that are really bringing us forex. And then there is the close to 1 billion that's coming as remittances from abroad to individuals like myself. And then that's the more important money that I just want to touch on here as we're speaking on inflation. That 1 billion is the money that's coming straight right up to just transact. When it's coming to me, I'm ready to pay school fees for my kids. I'm ready to buy my beer. I'm ready to buy my bread and things like that. But what's happening now is our manufacturing sector is actually down just because of this problem of forex here. So we're not producing enough. Someone's is gonna receive US dollars from America, from UK, from Australia, from their relatives. What are they gonna do next? They'll get the bus, they'll catch Intercape, and the next thing they're in South Africa. Then they use that same money to buy shoes in South Africa at a much cheaper price than what they can be doing here. They go to South Africa, they buy their freezers there instead of us buying our freezers here. So our major problem is actually on the problem of forex. Can we be able to generate enough forex so that we actually start producing? Can we be able to generate enough forex so that we bring in that good money and actually be able to restock our shelves and try and reduce that line over there? That's the question that can really be posed to Mthule as he's going to present his budget.
So in effect, you're saying for as long as the forex issue is not addressed, for as long as the levels of production in Zimbabwe do not increase as a result of the availability of the forex, we are likely to see the upward trend of inflation
very much so
in the country.
Yes. But just a quick one, I just want to correct that this jump here, we're coming from October, like what happened with October, the 2% tax, and then the spike in other TGS balances and stuff that led to a lot of panic buying and that really drove a lot of prices really high. So just going into November, December and stuff, we might experience a lot of price increase due to the festive season, but I don't think there'll be as much increases as what happened in October due to panic buying. So we might just see that trend starting to slow down, but it's going to be going up at a very slow pace.
Okay, so Anesu, you agree with him that we're not likely to see a replay of 2008?
So you find that companies like Rio Zim, which recently reported that they would have to be closing one of their mining operations, that means our trade is going to suffer more. Already trade is standing at about a deficit of about 2.8 billion, right? So if it means that gold and other production lines that are key to the growth of our economy, that are key to our exports, are going to start dwindling, that means we are not going to expect anything in terms of growth in trade, which then gives us a problem of foreign currency. Now, foreign currency already being a problem, companies like Delta are also going to be choking on the problem of foreign currency because already they cannot remit their shareholders with so-called foreign currency for them to for their investments in the company. Going beyond that, we'll also find that remittances are not actually going down into the government's coffers, or it is not really affecting the government in any way, because that money is basically coming straight into your pocket, and probably you're going to go and buy your bottle of cooking oil courtesy of Busisa Moyo, and you're going to buy a couple of other things. Now, for you to buy those couple of other things, the general man is probably just going to go on the black market.
Black market.
Yes.
Black market. The president, in a press statement, just said that there is now a 10-year jail sentence for the forex traders. Do you think that could have an effect of limiting the level of parallel market trade?
It could. But then, as Zimbabweans, we have seen a lot of survival tactics that have happened in the past 20, 30 years, albeit. So, besides the president giving us that jail sentence, the parallel market is still going to be prevalent. And that parallel market, having remittances come in, is going to cause for us to go back onto the parallel market, secretly trade the US dollar or the pound on the market, get my bond dollar, and then go and purchase in Pick and Pay, who essentially wants to import those products from South Africa, and so goes on the cycle, and on and on and on. And inflation will not be fixed if those things are not corrected.
In black and white, you are saying that this upward trend is most likely going to continue, but maybe not as at a high rate as we saw in 2008. Is that correct?
We could say so.
Beautiful, beautiful. Gentlemen, it's unfortunate we've run out of time and we're going to have to cut the show short. Viewers, that was Kenneth and Anisu, our investment analysts here at Equity Access, and this is Ibn Mabunda. Thank you so much for joining us. You can look forward to more of these presentations. Catch you on the very same platform next time. Thank you. Good evening.